Hey Deepak, lovely to meet you. Thank you so much for joining. Nigel Morris spoke very highly of you, and I actually attended the BCG event where you originally were talking through the report, which was I think it was either yourself or your colleague in London, and super interesting. And yeah, I think it would be really cool if you could start off by maybe just introducing yourself. And talking about your kind of career and where you've got to so far, just so the team can kind of get a good understanding of that.
Very happy to. Thank you for inviting me, Aidan and others. So I work for BCG. I'm 28 years into consulting, so I'm a career consultant at this point in time. 20 years at BCG. And I've been, most of my life, last 28 years has been on a plane. But good to be stationary right now. Part of the reason I guess you guys invited me today is I launched our fintech practice 2.5 years ago. So we have a group of about 30 partners across the globe who focus exclusively on serving fintechs, and I guess that's why I'm here. I'm a trained electrical engineer, but I only did electrical engineering for 4 years.
And you originally grew up in India, I saw from your CV.
So I grew up in India. I moved to New York 20 years ago. That's where I've been with BCG.
Oh, fantastic. And I guess like India is seeing a huge rise now as well. Do you, like I've seen some QED have invested in a few neobank there.
That's right.
Are you getting too involved in any of that sort of growth and things happening there?
I'm not involved directly. I'm not involved with the QED portfolio at all. But I mean, we have a huge practice in India. We serve many of these emerging fintechs. And my own brother happens to be a VC in India, so he invests in a lot of this stuff.
Ah, fantastic. Okay, brilliant. Well, maybe we can start. I know that yourself and QED collaborated on a global fintech report here in 2024, and I think it would be useful to use that as a kind of core framework for some of the discussion today. So for me, like, there was obviously like 5 main takeaways from that report. Do you want to give us an overview of those kind of key takeaways?
Yeah, very happy to, Aidan. We should also look at the 2024 report in the context of 2023 report. I don't know whether you guys have access to a 2023 report. So let me go back to 2023 and then I'll connect it to 24. When we did our first piece of research in 2023, and we looked at the global fintech market, it was completely doomsday for fintechs. I mean, I think if you guys might recall, the funding market had completely plummeted. Valuations had completely plummeted. And so we did this in the January to April timeframe of 2023, and everybody was like, oh, this was a fad, it's over, and now we are back to the real world. And I think our biggest insight from 2023 report or research was, no, actually, only the valuation and the funding has changed. And frankly, they were irrational valuations, which have corrected and maybe overcorrected. But actually, fundamentally, the fintech market is very, very on a very good path. So even through the worst of 2022, right, which is the second half of 2022, early 2023, if you looked at the fundamentals of the fintech companies, fintech as a whole, and there are 32,000 fintechs globally, right? So, I mean, I can't count everyone. Yeah. The revenue of these fintechs, which is a much better predictor for how they're doing, actually grew 21%, I think, CAGR or something like that, between 2018 and 2022. And even in the worst year in 2023, it grew 15 or 16%. So it's not like the companies are still doing very well. I think all that had changed was the investor sentiment.
Yeah.
The valuations and the investor sentiment have changed, but fintechs are gaining share. The second big insight for us was while everybody said, "Oh, have we reached what chapter are we? Like, are we in chapter 1? Are we in chapter 8 of this fintech market?" And I have to always remind ourselves. I said, "It's a very big book. It's a 600-page book. We're on the second paragraph of the first page. That's where we are on the fintech." And just to illustrate this, the global financial services revenue pool uh, is roughly 12.5 trillion.
Wow.
And the fintech share of that in 23, when we did the first research, was roughly 2%. So roughly 250 billion in revenue at the time. So
And
like
and Deepak, is that including like interest income from lending, SaaS platforms, payment infrastructure? Is that like insurance included in that as well?
everything. So just to put things in perspective, right? I mean, if you look at 12.5 trillion, about 6.5 is banking, 6 is insurance. So they're almost equally sized. The insurance market is massively skewed towards the US. The US is the over-insured market, if you will, or North
Yeah.
America. Banking is a little bit more skewed towards Europe and Asia. But so it includes all of the above, but it includes interest income. In fact, if you look at 12.5 trillion of banking revenue pool or banking financial services revenue pool, almost 2/3 of that is lending and therefore effectively interest rates.
Yeah. It's I find it fascinating. I was obviously raising money in 2022 and 2023, and the world was falling apart. And luckily, we had QED on board and have a much longer term view. So it was quite interesting. I noticed in the report that you kind of said that the B2C lending was one of the areas that there was big decline during 2024 over that period, which I was quite surprised about. Like, what was kind of driving that, or what kind of shifted in the market?
So I think what you see on B2C lending is, first of all, a big part of that was China. China was completely in a tailspin, if you will, in 2023 because of all the lockdowns and everything. So that was one major issue. I think the other issue has been, Aiden, has been, there is jury still out on all these neobanks and digital banks, whether they will succeed or not succeed. I think there have been some that have succeeded. Like, I mean, especially UK is a great market. I mean, where you guys are, right? The neobanks and digital banks have done well. Latin America is another very important market where they've done well. The new bank is probably the biggest digital bank in the world at one point in time. North America, the neobanks have struggled massively, right? They've struggled. I mean, there are a few, and Chime is going for an IPO soon, but it's not a market that they've succeeded. And Asia, I think the jury is still out again, like still in early stages. I think that the issue with the B2C market is that unless you do lending, you don't really make money.
Yeah.
Right. It's the revenue pool is not in the fee part, which is where many of the neobanks have tried to focus. The revenue pool is actually on the lending part.
Yeah.
Right.
No, I completely agree. Like, I think so many VCs shy away from lending. But it's how you make money in financial services. It's such a large proportion of the revenue pool that it just surprises me that it's not more popular. But I think it's changing. I think the world is kind of waking up to that. And
I mean, we have told, like, I mean, if you look at two original neobanks in the US, I mean, if you can call them neobanks, SoFi and Lending Club, they both had to acquire banking licenses to be able to have low cost deposits and do lending. That's the only way they sort of stabilized and are now doing well. Chime still doesn't have a banking license, and therefore can't really do lending, and that's a huge problem.
Yeah.
Right. And then if I connect everything that I said on 2023 to 2024, which is what do we find? Our first most important, we had 5 key insights. First, we think the fintech fundamentals are still very strong. Despite the worst year that we saw in 2023, the fintech fundamentals are still very strong. I mean, even through that, the fintech revenue pool grew 14% CAGR. And
Wow.
if you ex China, because China was like such an anomaly in 2023, because I mean, most of the country was locked down, the market actually grew 21%. So even in the worst time of fintech history, the market grew 21% for fintechs. The number 2 for us was that we think embedded finance is going to be big. And there is a very fundamental reason for that. We believe financial services are best consumed in many cases in a non-finance journey. Like, I mean, when you check out of Amazon, that's a very sort of silly example. I mean, you just pay for it then and there, right? It's part of your journey. Like, it's not like you don't write a separate check to Amazon. So, and similarly, like in so many ways, the embedded finance will be consumed very differently, and in a lot of ways as embedded finance. So we think that's going to be a humongous market. It's already on the way. The new thing in 2024 for us was the rise of connected commerce, which is financial services companies using the information they have about their subscribers as a way to make them offers. And I think I almost call it like crossing the Rubicon, because I think there were companies that were already doing this, but the mainstream player announced it to the globe that we're going to do it, which nobody expected. With 100 million customers, one of the most conservative banks on planet decided to use its data about its customers to make them offers. Amex has gone into it in a big way. Citi is doing it. Wells Fargo is doing it. So, like, I mean, literally, there was a deluge. Everybody is jumping into it, right?
Is that and what you mean by that is you're effectively saying that it's using their data to offer consumers or help drive consumers towards transactions or like special offers or things like groceries or discount off things, that kind of stuff.
The latter, right? So if I'm like my consumer bank, my Chase consumer bank has like 30-40 million customers, and like I'm a diaper manufacturer. Like, I want to target parents who have young kids. I can make those offers on the Chase app.
Yeah, wow. We see that with Carmilla. So Carmilla is a direct-to-consumer auto finance lender. So very similar to sort of a Klarna style journey where you download an app, get a budget, 60 seconds, and then you're able to basically buy a car instantly. One thing that we've seen as a result of that is very interesting how much control around the customer experience you have and pointing them to different dealerships and how much leverage you have over that. So I guess that's a similar concept. I think leveraging that data over time could be really interesting for us.
Today, if you go into your Chase app or your Amex app, you get offers in the app and you can click on them, you can get to the route. So it's now becoming way more mainstream. And this was not a revenue stream for banks at all.
Yeah,
this is
interesting.
Revenue stream. And then the 2 other insights we had from 24 were the one thing that has this whole downturn 23, 24 has done is it has told fintechs that it's not just, and frankly, the investors, it's not just about revenue or growth at any cost. Profitability is important. And so we did a whole bunch of analysis on how like what's the opportunity in terms of profit improvement for fintechs. And we think it's humongous. And many fintechs are just immature. Like, I don't think they even think about it. So profit is important and can be done. And then the final one for us really was that this market still needs intervention from the government. There are so many parts of this market that could benefit from a responsible regulation. Because there are things that just only governments can do, the state can do, I mean, the classic example for me is the this digital public infrastructure that Brazil has created around PIX. I mean, Nubank has benefited enormously from that.
Yeah.
And I mean, look at the the other extreme example is the US. The US has just basically left it to market forces, and it just doesn't happen. US is one of the worst, the least developed payments markets in the world.
Wow.
Right. Same thing with crypto. The lack of regulation around crypto has basically meant that this market is just enabled to take off. And I mean, we saw the decline. I mean, we saw the demise of FTX last year, and so on. So again, maybe with the new administration, things will happen. But I caution against over-regulation, but I also caution against under-regulation.
Yeah. Yeah, look, it's super interesting, that point. Just going back to your point, because I remember the go-go days of 2020 and 2021, where it was kind of growth at all costs. When you mentioned in the report a lot about profitable growth.
Yeah.
What do you mean by this? It's like it's a term that we see quite a lot, and lots of our, I talked to the team about it. Like, what is your kind of meaning of that when you're in a growth business?
I think do you guys also in the UK look at the rule of 40, where you do?
Yes, I've heard it different things. The rule of 40, and sometimes depending on where you are, rule of 50 as well. But yeah.
Right. I think if you look at the rule of 40 and you look at the two components of rule of 40, the growth and the profitability, I think in 2020 and 2021, you were only looking at one side of that, which was only about growth. And I think that was fine. But a lot of growth was just bought. Like, I mean, look at Uber in so many markets. They were just literally underpricing consumers to get the rights, to build their revenue. I mean, India is a classic market. I mean, Uber has completely fallen off the cliff, right? Because the moment shareholders stopped funding those individual rights, and Uber had to charge the consumers, like suddenly just the market fell off the cliff, right? You can't sustain that. Like, and in so many businesses that was happening, which is you were pricing consumers below the cost of provision or the fair cost, and you were just buying market share. And that is not sustainable. You can do it for a year, you can do it for 2 years, but you cannot do it forever. And shareholders woke up to it, and and so our point is that yes, you should look for growth, and many of you are in growth stage, or even some are early stage or growth stage. So growth is important, but you cannot completely ignore profitability. And there were all kinds of random things happening. People going on junkets to Caribbeans and blah, blah, because nobody cared about anything around cost. There were lots of hobby projects going on. Oh, if I'm a founder, let me just start this, and let me start that, and let me do that. Like, there was as if the only line that mattered in the P&L was revenue, and nothing else mattered, because they were shared to fund your growth. And
I think it's interesting, the balance in an early, like a relatively early stage, when you're going from sort of 10 to 100 million in revenue, you kind of got to balance your unit economics and making sure your underlying unit economics are strong with a level of growth that is exciting enough to show that you're really going to be disrupting. And I think obviously at one point, there were companies that were negative unit economics with no real view on how that will ever become positive. And it's interesting because you're kind of now in this dynamic where you've got all of these AI companies that are getting funded extremely quickly. And then, like everyone else has to show incredible traction to raise money. And therefore, it's an interesting kind of dynamic that's kind of happening. Do you have any views on how that's kind of playing out and what you're kind of seeing?
Sorry, in what way? You didn't say that again?
Like in terms of is there a level of growth that you kind of need to be thinking about? Because there's like with your 20 or rule of 40, there's no point growing at 20% a year if you're, 10 million of revenue. You need to be growing at a fairly decent, substantial rate to be seen as something that's disruptive and likely to really kind of change a market.
Yeah, and look, I think Aidan, the answer differs from early stage versus growth stage versus late stage. I think in the early stage, I do agree that growth is the most important thing, right? I mean, and you will skew towards growth at the expense of profitability, and I don't think market expects early stage companies to be profitable. I think it's just more about responsible growth. Like, don't fritter away money when you don't need to fritter away. But I do agree that early stage, I mean, it's all about product market fit, and you have to show growth. That's the only way to show product market fit. But I think as you start to transition into growth stage or late stage, profitability starts to matter more and more.
Yeah, no, I agree. But I think I love reading about lots of autobiographies about entrepreneurs. Probably read a book a week on something, and throughout history, all the best entrepreneurs have been super cost conscious and just being absolutely crazy about making sure the cost is super lean. And I think, like, I don't know where it came from that these people were just wasting so much money on stuff during the go-go years. It was crazy and just bad business, I think. You talk a lot about the NPS of fintechs and just how much they're so strong. Carmona has an NPS score of 91 to 92, fluctuates in that kind of range. What do you think it is that kind of is driving in fintechs? Just if you look at the banks, I think in your report you state the traditional banks have about a 23 NPS, where you're seeing some of the neobanks are sort of 83 upwards. Or like, what do you think is it purely about the brand? Or is it really about just the user experience? Like, what do you think it is? Is it a combination of multiple things that's driving that? I'll be interested to kind of hear that from you.
I mean, Aidan, it gets down to the basics, which is, if you look at most fintechs grew up, their whole raison d'être, if you like, has been, we will disrupt the market. We will give you a mousetrap, which is way easier, simpler, better to use than traditional banks do. Traditional banks typically come at it from a risk point of view. They're risk managers. They're not necessarily about the best customer experience and the simplest customer experience. I think that's one part. The second is also the speed of innovation, right? It's like the speed at which fintechs innovate. Like, you come up with something today, but you release the second thing in 15 days from now and the third thing from 45 days from now. I think the fintechs have just come from a completely different mindset. Most fintech founders are engineers, product designers. They're not bankers. That's the legacy most of them come from. And they constantly keep innovating, which banks find very, very difficult to do. And that's why this gap, NPS gap, continues to be so stark. Now, it doesn't mean that some banks are not trying to catch up. Like, I mean, you go to Chase and they will tell you that 2,000 people working on their mobile app, and they are doing stuff. But, and they are probably one of the better banks, but there is still a gap, and this is a moving goalpost, and the bar keeps rising higher and higher.
Yeah. No, it's fascinating. Like, I think there's like an element of like brand and counter positioning though. Like, I don't think it's just all about the customer experience. I think like some of it is about the customer experience, but I think a lot of people like that are using Revolut have a much more positive view of them because they're not seen as like the old way of doing it. And I think that does also impact the NPS as well, which I think is a different way of kind of thinking about it. I know we haven't got long left, but I do want to touch upon AI as it's is a hot topic, and I know that you've done a lot of research into this. What are some of the areas that you're seeing people leveraging AI in fintech, and where what do you see as some of the core benefits that are kind of coming through?
Yeah, look, I mean, this has been one of the hottest topics, and you could even argue there's a bit of hype to this. But first of all, let's start by saying AI is not a new thing. It has been happening since the 80s. Like, just we didn't call it AI, we called it predictive modeling, we called it something else. And of course, the algorithms and the amount of data you can ingest and has changed. But let's just first agree that AI is not a new thing. I think part of what is new is actually, first of course, the level of computing you can do and how much of data you can ingest, but also generative AI is somewhat new. That did not exist. So the second thing I would just say is, first of all, I look at AI and Gen AI as a spectrum. So AI is more the predictive part of it, and Gen AI is, of course, the generative part of it. And most use cases today, Aiden, include both. It's not one or the other, right? Now, AI has been used in fintechs forever. Like, it's been this. That's not a new thing. I mean, you look at a lot of companies, fintechs in the US, which were all about looking at second look at the loans. They were basically using AI for a long time. Okay. Mm-hmm. If you look at AI, at least how we think about AI, we think about the use cases from AI in three big buckets. We think you can deploy AI in small use cases, like what we call deploy. Just you can deploy it in so many different ways, in small tasks, and you can automate them. That's one way to think about AI. I think there's a second way to think about AI, which is you can reinvent hitherto different functions completely based on what AI and Gen AI can do today. You can completely reinvent, and I'll talk about a few examples. And a third is where you can use, and this second bucket is mostly, in my view, about productivity. So it's efficiency, productivity, to some extent effectiveness. And the third bucket we think is really all about new frontiers, where you're actually using AI, Gen AI, to develop new products and services that did not exist. So almost revenue side. You can use them for the revenue side. I would say that if you look at the second bucket, to reinventing functions, there has been a lot of work. And I think if you look at financial services, there are 3 or 4 main use cases that I think are at this point in time beyond experimentation. They are in production and being scaled up. I think the single most important use case I've seen is customer support. I mean, Klarna has been very active and public about it, saying they have taken 70% of the people off from customer support. But I just did work for a tier 1 bank, and we basically said they have 27,000 people in customer support, and we think almost a half of those people will not be required in 2 or 3 years from now. Wow. And that's so the customer support, I think, is a major use case in my mind. So that's number one. I think a second major use case for me is everything around software engineering. So code development, testing, documentation, and code migration. Those are the 4 things. Okay. We ourselves, BCG, we have 1,000 people technology organization. We are using this like Microsoft Copilot and so on, and we are already seeing 20 to 30% productivity improvement. At scale, I've seen this at scale, and they're already seeing 10% productivity improvement. But the promise is actually humongous. I think this could be almost 2x once all the kinks in the way this is deployed is taken out. So we think software development would be a huge use case. Okay. A third big use case that we have seen is document management. Whether it's especially when you have to convert unstructured data into structured data, and you have to re-engineer the whole process, whether it's in mortgages or others. Like there's so much of paperwork that happens in financial services. A lot of that can be automated using AI and Gen AI. And so we think that's a third very big use case. And the fourth very big use case we have seen is in marketing, especially digital marketing. And that spans many, many things, from all the way from making copies to automated response to customers, etc. We think there's a big use case out there in digital marketing, especially. Those are the four big use cases, I would say, at this point in time.
And then on the revenue side, is that like, how do you see that being developed for fintech?
Aiden, I would say it is still in early stages, the revenue side of it. So I'll give you one or two examples that I know of, like in very well known. Like if you look at S&P Global, they've actually come up with a new offering in their Capital IQ offering, which is all based on AI, Gen AI, right? So that makes it so much faster to get the insights, to do the search, etc. So that's just like one example. They've come up with a new offering, they charge differently for it, and customers are lapping it out. Another example that I will say, again, these are more mainstream companies. I haven't really seen that in fintechs. If you look at this company, L'Oreal has come up with a digital beauty assistant, which basically, women can go onto it, and they're lapping it up and they charge for it, which is literally you switch on your camera, the AI actually advises you what makeup to use, in what order, etc. That's a new offering that would not have been possible till AI, Gen AI was at the level it is. So it's a new offering altogether. But again, I think those examples are still few and far between. If you ask me, most of AI, Gen AI is still being used for productivity improvement.
Yeah. And what's your view on the end result of all of that? Do you see a world where fintechs can operate much more efficiently, the ones that are deploying this, and that basically increases margin? Do you see them, like, I think there's an argument around lending that potentially this technology has the ability to reduce risk through various models and risk management that you could utilize. Like, is there a view that, ultimately this means margins are improved, valuations on these businesses will increase over time as the technology develops?
100%, Aiden. There's absolutely zero doubt in my mind. That's what is going to happen. By the way, it's happening in our business. We are now using AI and generative AI a lot to develop our documents, to do research behind our clients, etc. Now, again, I would still say those are sort of smallish use cases, but I have zero doubts in my mind that AI is going to be a fundamental force in the fintech space. And fintechs, because of their ability to experiment and innovate faster, I think are going to be at the leading edge of this one way before the rest of the financial services adopts it.
Yeah, wow. That's been fascinating. Deepak, I'm super grateful for you giving us your time, and I would love to pass it over to the team for some Q&A if we can. Has anyone got any questions they would like to ask? Go for it, Anders.
Hey, Deepak. Mine is actually about AI as well, seeing as you were just talking about it. Because this week the government launched its AI Opportunities Action Plan in the UK to try and, because I think there's a bit of an arms race globally for who can own this space and be seen as a leader in it. But from a consumer perspective, like you say, AI has been talked about or has existed for a long time. It's only recently that I guess it's entered mainstream conversation and everybody is talking about AI. Even, tabloid newspapers talk about it. Are you seeing anything from your research or just anecdotally that suggests that consumers are put off by or receptive to AI if they know it's happening or if they know it's something they're engaging with? Are they put off? Are they scared by it, or are they seeing it as a good thing that the company they're dealing with is advanced enough to be utilizing it? If that makes sense.
So Anders, I do think there's skepticism on the consumer part still, right? But as technology is improving, that skepticism starts to get bridged over, if you will, right? I mean, I think we are still in that S curve, in the lower part of the S curve, that we are still, consumers are becoming, the technology is becoming better, the consumer is still getting used to it. I mean, I'll tell you that now I don't call my call centers at my banks. I just go and do the chat, and it's way faster, way quicker. And look, I also keep an eye on, because I know I'm talking to a machine, right? I know I'm not talking to a human on the other side. But I'll tell you, for 9 out of my 10 needs, that's enough. Now, sometimes there is a very specific thing that I know just the robot is not, the machine is not going to be able to answer. And then you need a human in the loop, right? I mean, then I need to speak to a representative. So, but I think this is going to be, I think consumers are going to adapt to it, right? I mean, if you call a Bank of America call center today, you are talking to a machine for the most part. And then they route you to a customer agent when the machine is not able to solve it. And it's like almost like a human level conversation.
Some of them are so good now. It's incredible. Like, yeah, it's really, really cool.
So again, there is a little bit of training as a consumer as well. Like we'll all get trained a bit to know when the machine is enough and when it is complex enough that we finally do need to speak to a human. But remember, there's so many stuff that is so simple that you don't need to talk to a human.
Yeah, it's interesting. I definitely see a world where people will start to become more and more used to these chats and these things, and they will expect the chat to deal with the problem in the chat. So, for example, if you want to contact the chat and you want to change your payment date, or you've got a problem, I think they will get so used to that chat interface that the expectation will be that will sort it, that you're not redirecting them then somewhere else to go and fix it.
So, Aiden, I'll give you a real statistic. This tier 1 bank that I work for, which is one of the largest in the bank, they get 150 million calls a year on their call center.
Wow.
20% of the calls are less than 90 seconds. What that tells you is these calls are so simple. Like by the time you get authenticated and even solve the problem, 90 seconds, the call is over, okay? These calls are like, oh, I forgot my password. I, couldn't log in. Like really silly stuff, okay? A machine can so easily do that. You don't need to speak to a human. This is not like a huge complex conversation about, oh, I took a loan, my collateral is like this, there is a lien on this one. Like it's not a complex conversation at all.
Yeah, super interesting.
I mean, in Bank of America, if you call the customer center, most likely you will not go through a menu-based IVR anymore. Somebody will come online and say, okay, sir, what do you need? Like it's literally it's the menu-based IVR, in my view, is going to just disappear in 2 to 3 years from now.
Yeah.
It's just going to be a plain, simple English conversation.
Very cool. Go on, Nell. Let's pass you to your question.
Yeah, it's actually kind of leading on from this. In terms of customer service using AI, do you think there are any companies that are kind of at the leading edge of this that like would be a good example for us to kind of look at and learn from?
So Nell, I will give you a couple of examples. One that I know of personally, and then one that I've only read about. So I'll give you 3 different examples. I'll start with, look, just because of the nature of our work, we of course still serve a lot of large companies. So I'll give you 2 examples on that one, and then I'll give you a fintech example. Verizon, which is the largest, telco in the world. I can't remember, but they have like humongous number of calls every year, like 100 million plus calls every year. They don't even have a taxonomy of the calls. They don't even know why they get calls.
Wow.
So if you think about the old world, how do you know why did the customer call? You basically ask the agent who picks up the call and says, here is a menu. Pick one of them. Like it's like The customers can call for 30 reasons. Okay, tick one of them, and you basically keep logging that. Okay. Now think about what is happening in the new world. First of all, those 30 reasons may or may not be right. They may be partially right, and you don't get any insight. Like what happened? Like one of them will be, oh, the customer called for fraud, but you don't know the second level. What was the fraud? Why did the fraud happen? Like you have no idea. So you don't even know what you have to resolve in the back end so that this doesn't appear. Now with Gen AI, you can actually listen into those 100 million calls. Every call, every second of that, you can listen in. You can't put humans to task and say, go and now listen into 100 million calls. Like, I mean, you will need a workforce of 100,000 people just listening into calls. With Gen AI, you put a Gen AI agent to listen into the calls. And literally, when you do the analysis, you find those are not the same 30 reasons for which the customers called. They actually called for 175 different reasons. You know the level 2, you know the level 3, then you know what you can eliminate by doing what, right? That's one example. Second example, Santander. Santander has now deployed things like Gen AI assistant next to their human agents. They are listening into the call while you're talking to John on the other side. John is being held by a Gen AI assistant. The Gen AI assistant recognizes the customer's voice, pulls the whole account data for that customer while John is speaking to you. The Gen AI assistant is transcribing the call. John may or may not fully recognize what are the two things that the customer is asking for. The Gen AI assistant can recognize that. Gen AI assistant is telling John, I think the answer is either 1 or 2. So your customer experience improves. The call handling time goes down from 7 minutes to 5 minutes. That's a 30% improvement. Okay. And then the third example I will give you is Klarna. And again, Klarna is the one that I don't know from the inside, but I mean, they have been very public to say they have basically reduced their calls customer support by 70%. Now, I don't fully know whether that's true or not, or that's publicity and like, I don't know what's underneath that, but I'm sure that they have done something because they've been so vocal about it.
It's not a coincidence that they got an IPO coming up probably either.
Yeah, no, completely.
Fred, have you got a quick question?
Yeah, you mentioned the multiples, right? The valuation multiples was super high in 21. Do you think these levels will come back, or the world has changed a bit more permanently? I guess rates probably be higher for longer. On the flip side, you know, there's still billions of dry powder everywhere. Private credit is booming. Trump is gonna, you know, boost U.S. economy and all these kind of tech businesses. So what's your view there?
Frederick, at the peak in 2021, the fintech multiples were 20 times revenue. You can do the math. If you do the DCF analysis, what kind of growth, right? It's never coming back, in my view. Like, I mean, if it comes back, I think this is just harakiri in my mind. Like, that was stupid. And
wasn't it? I think a firm was trading at 54 times revenue at one point, wasn't it? So just,
yeah, and the market as a whole, like, I mean, 20 times, like, that's crazy, right?
Yeah.
Today, the fintech multiples are still about somewhere between 4 and 6 times revenue. If you look at a traditional bank, they typically trade at 2.5 times revenue. Okay, so fintechs are still much higher multiple on revenue.
Yeah.
Okay. I mean, could 4 to 6 become 8? I could see that. Like if there's another hype or wave or whatever, I just don't see 20 times revenue. Like, I mean, and if there are investors who are willing to invest at 20 times revenue, I would never want to invest money with them.
That's super interesting. Great. Deepak, I don't want to take up any more of your time. This has been absolutely fascinating. Thank you so much. We're all extremely grateful, and yeah, really appreciate it. You coming on and sharing your insights, especially the stuff around AI. I think it's fascinating. So thank you very much.
You are very welcome. Can I just make one last comment on AI, Gen AI, which I failed to say earlier? One of the biggest insights we've had as a firm, right? Because we're probably doing like 500 AI, Gen AI projects for our clients at this point in time, like literally as I speak. One of our biggest insights has been that if you think about a deployment of AI, Gen AI, everybody gets excited about the algorithm and the data. And we say it differently. We say, if you want to get real benefit from AI, Gen AI, think of 10, 20, 70. 10% of this is the algorithm. 20% is the underlying data. But 70% of this is the business process re-engineering. If you don't re-engineer the process behind it, you can have the best mousetrap. It'll never get used. I'll give you a very classic example. This bank that I was referencing, tier 1 bank, top 3 banks in the world, they developed a very cool Gen AI assistant for their customer support. When we looked at their utilization, it was less than 10% of the calls on which the agent would even switch on the Gen AI assistant. The adoption, the re-engineering of the process, the cultural change, the KPIs you look at. If you don't re-engineer the process, you can have the best AI, Gen AI, and nothing will get used. Sorry, with that, on that high mark, I'll leave you guys.
No, that's fascinating. Thank you so much. Really appreciate it.